Hey guys, what's up and welcome. In today's video, we're going to be listening to Mr. Jeremy Siegel. He says the Fed, Jay Powell, has to be very alert to slow down. He's going to be talking about some upcoming interest rate moves, whether that be hikes or cuts. As always, I hope you guys enjoy this video. Hope you learned something. If you do, smash that like button and subscribe, and let's jump into it.
Jeremy Siegel, Professor Emeritus of Finance at the University of Pennsylvania's Wharton School of Business. Time goes fast. You were just on, but you were not on. You were on before we had Wednesday, Thursday, and Friday of last week. So all the things that happened, Jeremy, I would say you were probably nodding and saying, see, Powell has done enough. The market itself has tightened conditions to the point where no more Fed action is likely necessary. And that seemed to dawn on the bond market and even on the stock market.
Yeah, absolutely.
So what he's referring to there is the Fed meeting. They decided they're going to stay paused. So that was very, very bullish for the stock market. And also the treasuries have been plummeting. So we've got a double bullish call for stocks, and the stock market rally is back on.
Absolutely, Joe. And by the way, I think Jay Powell has to be on high alert because we did get some weak data, certainly on the ISM jobless claims, and certainly on Friday. Listen, let's be frank. The Fed cannot screw up the way it did on inflation by waiting a year too late. Now, I'm not saying we're going to get a recession or anything like that, but he's got to be very alert to slow down. And if the data continues weak, he really does have to consider lowering rates next year, even though inflation is going to be sticky. And by the way, you know, for a long time, I reject the narrative that the Fed had. Oh, we can't be like the 1970s, the stop-go policy. We got to kill inflation. This is totally unlike the 1970s. In the 1970s, Arthur Burns and the Fed poured on money every single month of the year, 8 to 10%. In the first half of this year, we had a shrinkage of money that was the greatest in 80 years. And then it began recovering. I felt better. The last 2 months, money has fallen again. Liquidity has fallen behind. Bank deposits have now fallen below the level that we had after the SVB crisis. Now, again, I'm just saying it's not the 1970s. And I just don't want him to delay the way he did on inflation. He's got to be flexible. I think that's what the market liked about, you know, his attitude into Wednesday. He seemed more two-sided, but he really has to be truly two-sided because we do have two-sided risk right now, and the downside is looming much bigger than it certainly did a week ago.
So you weren't just kind of nodding a little last week. You were like, this is all the things that you've been saying were coming home to roost in terms of whether the economy had already slowed down, whether the Fed should take a light touch. So in your view, we're still talking about data dependency on another hike. That's You're still here. That is not what you think at all.
I think the Fed should be done.
Yeah, and you think maybe the next move is a cut.
I think the next move is a cut, and it might come even sooner than we think. Given the data, I mean, you know, I'm not predicting a recession. We've got to look at that data. But it's begun to turn. We've got to be on alert. You know, some people are talking about we've had a 0.5 percentage point rise in unemployment. Some people have said that has signaled many recessions in the future. I'm not there yet, but I just don't want a stubbornness on the part of the Fed the way they were on the, you know, the inflation side. On the downside, they have to be on the alert. And something else, this, you know, Joe, you led off at 6 a.m. because I was listening to you, you know, with the New York Times poll. Can you imagine what it would be for the Democrats if there's a recession next year? I mean, as precarious as their situation is right now. I mean, wow. I mean, it would be disastrous.
Yeah.
And, you know, and a lot of people are saying, oh, we're going to have a recession like that. Not going to have a lot of consequences. It's going to have the worst political consequences that we've had for decades for the power, you know, the party in power.
Or the incumbent.
And so that means, what does that mean? Tremendous political pressure by the Dems and Biden to say, hey, got to look at this. Don't forget the Fed has a dual mandate. And, he has to look at that.
Yeah, that I wonder, that will play into it. And now, the closer we get, now it's less than a year. So that is going to be front and center for how the party that's in power decides to avoid that slowdown. What about what was worrying people last week, Jeremy, and that is the supply. The supply is not going to go away even if the economy it does slow. And with $33 trillion to finance at these higher rates, so couldn't that cause, if people aren't going to buy, I need to get paid to buy a 10-year. So yields can't come down that far for me to go out 10 years.
Yeah. But, again, yield going down will help that debt overhang. And by the way, we I think Ed Yardeni mentioned, and something I've mentioned, we do have a really strong productivity recovery. And the promise of real growth being better in the next 5 or 10 years with AI and other factors mitigates some of the immediate debt problem. I don't think the debt problem is going to be the big picture over the next 12 months. I say it's going to be whether this slowdown accelerates and how fast the Fed will respond to it if in fact it does decelerate.
All right, we're going to go, and we will, good to have you on and update what you thought.
All right, so there's Jeremy Siegel giving his thoughts on what he thinks Jay Powell is going to be doing next. He thinks the next move will be a cut. Me personally, I think the next move, we're going to stay paused for a good while. He has been saying higher for longer even before we got to the level that we're going to stay higher for longer at. He's trying to give us a path. He's trying not to have any surprises. Jay Powell, he's trying to tell the economy exactly what he's doing so that there's no guesswork. He doesn't want to spook the markets. He wants everything to kind of be in a soft landing. He can't be too dovish. He can't be too hawkish. He kind of just has to walk this tightrope. And then you throw elections in the mix. Guys, it's going to be messy because this change of power can dramatically change how we deal with this slowdown. There's a lot up in the air these next year or so, maybe even 2 years. Markets seem to want to have this Santa Claus rally, guys. We were down coming into November, and they statistically over like the last 100 years, when you're down going into November, December, and January are great times to rally. They call it the Santa Claus rally. And it looks like we just started, guys. We had the biggest weeks in the NASDAQ in forever. It was like up 6+%. The S&P 500 was up almost 5% if it wasn't 5%. Guys, just gigantic weeks. There's a lot going on, guys. So as always, if you want to stay tuned with the news, hit that subscribe button. I thank you for watching. Hit that like button if you enjoyed the video, guys. And I'll catch you in the next one. Peace.